Hello and welcome. This is Professor Swark, and today we are going to walk through Chapter 3. I want to remind you that these are selected topics in this video, and you are responsible for learning all the material from the chapter, including vocabulary, conceptual, and financial ratios. If you are struggling through any of these topics, make sure that you stop, read, review the videos, seek help from your instructor, or go to the tutoring center. Once you complete all your coursework for this chapter, you should take notes, create flashcards or other study aids, and quiz yourself. During this ACC session, we're going to do a quick review, and then we're going to go into two important topics: adjusting entries, and you can see the 4 types of adjusting entries we're going to cover, and closing entries. These two pieces are complex for most students, so make sure that you allocate an adequate amount of time during this period to study through adjusting entries and closing entries. The accounting cycle looks like this, and so far up through Chapter 2 we've learned to analyze transactions, journalize them, post them, prepare an unadjusted trial balance, and then we've gone right to financial statements. In this chapter we're going to learn how to do final adjusting entries before we prepare the financial statements. And then when we're completely finished, after we've prepared the financial statements, we'd want to close out all of our accounts and prepare post-closing trial balance. And I like to think about closing kind of like wiping out and starting with a fresh slate. So we'll talk about that in a little bit. Let's start with a warm-up. This is from your handout. So go ahead right now, pause the video after you've listened to the instructions, but list out the accounting equation, including the 4 pieces of equity. Record T accounts under each one of the sections and indicate which side is an increase and which side is a decrease. Okay, and if you can't do this without looking at any notes, you need to stop and study. Once you've listed out, you should have something that looks like this. So you've got ALO, assets equals liabilities plus equity, and there's 4 pieces to equity: common stock, revenues, expenses, and dividends. And remember that assets increase with a debit or on the left. Liabilities are a mirrored image of that. They increase on the right as well as common stock and revenue, but expenses and dividends go back to an asset. Okay? They increase with a debit like an asset does. If you're struggling with that, remember Ed's our troublemaker. Ed increases like an asset. All right. Our second piece that we're going to look at is a corporation had the following assets and liabilities at the beginning of a recent year. This is like a homework problem that you'll have, and you need to analyze and determine net income for each of these scenarios, A and B. So at the beginning of the year, assets were $13,000, liabilities were $5,000. At the end of the year, assets were $18,000 and liabilities were $7,000. Okay, there's something missing here, and that's equity. Okay, so we've got part of the accounting equation, but we're missing equity. And we need equity. We need the full piece, the full balance to figure out the solutions here. So we want to determine net income or net loss during the year if A or B. Okay, so if we first start with assets equals liabilities, we can plug in owner's equity here, and we can see, and I'm sorry, owner's equity is just coming from $13,000. The difference between $13,000 and $5,000 is $8,000. Difference of $18,000 and $7,000 is $11,000. So we can see that equity increased by $3,000. Okay, that's step 1. And then you need to realize that equity can be changed by 4 different things. This is C-red, right? Common stock, revenues, expenses, and dividends. And revenues less expenses is net income. So we can really narrow down a change in equity to 3 different pieces: common stock, net income, or dividends. Okay. Oops. I'm going to go out of order here. My PowerPoint slides must be messed up just slightly. But in scenario B, we have common stock. The owner invested an additional $1,000 cash in common stock and paid $200 in dividends. So we know there was an increase to equity of common stock and a decrease to equity of dividends. And we don't know what net income is, but the overall change is $3,000. Okay, so now we know that the difference here between $1,000 and $200 decrease would be $800. So 800 plus A, our unknown net income, equals 3,000. If we take away 800 from each side, that means that A equals 2,200. Okay, and I always like to plug them back in. So 1,000 plus 2,200 minus 200 does equal 3,000. If we do the same thing for A was no investments and no dividends. So our three pieces to equity: common stock, net income, and dividends. There was no change in common stock, no change in dividends. That means that the whole change of 3,000 was related specifically to net income. All right, so now we're going to go into adjusting entries, our first lesson. Okay, so adjusting entries, there's four pieces: prepaid expenses, unearned revenues, accrued expenses, and accrued revenues. And the first thing that I want to say is that basically adjusting entries, when you're talking about adjusting entries, there's really been no external transaction. There's been no additional purchases or no additional revenues that have been earned. It's everything that we've done to this point, and we just need to make sure it's reflected in our journal entries. Okay, so transactions may have occurred internally, or maybe we did some work, we just haven't yet billed it. Okay, and at the end of the period, so whether that period end is December 31st or some other period end date, we need to make sure that everything has been reflected. So adjusting entries, the first thing to realize is it's kind of an internal adjustment. Okay, nothing happened. The first one we're going to analyze is prepaid, or sometimes they're called deferred expenses. So you already know what a prepaid expense is. Basically, prepaid expense, remember, is when we prepay for something, but we've not yet used it. Remember I told you that we would learn that entry? So we talked about insurance being prepaid or rent being prepaid. And supplies is another type of prepaid account. It's something that we ourselves are prepaying and controlling, but we're prepaying for our supplies. We're putting them into a supply cabinet, and we essentially don't really touch that account until the end of the period. So it's not cost effective to transfer over an expense every time somebody takes a pencil out of the supply cabinet, okay, or every time somebody takes a stack of staples. So what happens is we generally leave that account alone until the end of the period when we do a final count and then make our adjusting entry. Okay, and the adjusting entry, remember, is to record an expense. When something is used up, we record an expense. So here on during 2009, Scott Company purchased 15,500 of supplies. Scott recorded the expenditures as supplies, an asset, right? On December 31st, account indicates that there is only $2,655 of supplies on hand. Okay, so we went into that cabinet and we looked and we saw that there's $2,655 left in supplies. So nothing happened to, we didn't use all these supplies today. It happened over time, and today we're going to make that adjusting entry in our books. Okay, so nothing really happened at the moment, but we need to reflect this change that's happened over time in our books. Okay, so first thing I'm going to give you is just a T account. Our balance in supplies was $15,500. Our true balance should be $2,655 when we put in the adjusting entry. So the difference between the two is $12,845. We used $12,845 of supplies, and we need to record that in our books. We need to make a journal entry for this. So here we have the credit. The credit is to supplies. But now we need to record a debit. When we use something, it becomes an expense. And just to give you a vision here, if you think about a bottle of water, unopened bottle of water, that is an asset. It's something that you own, you control it, you could sell it to your friend, you could throw it away. Okay, you own and control it. It's an asset. Once you unscrew that top and start drinking it, it's no longer an asset. It's an expense. You've used it. Nobody's going to want to buy your water anymore. Okay, and that's kind of what's happening here. We've used these supplies now. They're no longer assets to us. Now they've been expended. So we want to go ahead and record an expense, supplies expense. And here's where students often mess up. They want to take this bottom number, this balance, but we don't. We want to take how much actually got used. Okay, 12,845 was used, so therefore it requires an expense. Then we credit supplies, and again, students want to go to this balance amount. Don't. All we're doing is focusing on how much got used. Okay, $12,845. Okay, so $12,845 was used. We take it out of supplies. Once we post that entry, what's going to happen is this $2,655 is our balance in supplies. Okay, so don't get confused. The ending balance doesn't get recorded in the journal entry. It's just the remaining balance. What we record in the journal entry is to make sure that our accounting database reflects the correct ending amount of $2,655. Okay. So you're going to do these types of entries for, again, things like insurance. If you buy a 6-month insurance policy and now 3 months has lapsed, you need to record insurance expense and reduce the amount of prepaid insurance. Okay. The other type of prepaid asset that the book talks about is our fixed assets, our long-term assets such as equipment, vehicles, buildings. Okay, those assets, those long-term assets, are items that we own and control. But we want to go ahead and depreciate or allocate the cost over the life that we use that asset. So depreciation, oftentimes students think of depreciation as, the depreciation of value, and it's not. In accounting, it's an allocation process to record the cost of long-term fixed assets over the life of the asset. Okay, and this chapter will teach you how to compute depreciation, but I don't want you to focus on that. Okay, don't learn the computation, the formula for depreciation. Just learn that depreciation is an allocation process, and the journal entry looks like this. We debit depreciation expense and we credit accumulated depreciation. And my acronym here for you is DED. D for depreciation expense, E for expense, A for accumulated depreciation, and D for depreciation. So DED, depreciation expense, accumulated depreciation. Okay, and I like to talk about computers because, perhaps you went out and bought a computer to use while you're in school. Okay, and maybe you're planning on a 5-year school. Either you're going to take 5 years to earn your bachelor's or 4 years plus 1 year of master's, I don't know. Whatever your goal is here. But you bought this computer, you intend to use it 5 years. Well, the cost of the computer is $2,000, but that's okay because basically when you allocate that over the time that you're going to use it, you're basically incurring a cost of $400 per year. That's what depreciation expense is all about. Yes, you output the money in the beginning when you bought it. Yes, now you own an asset. But when you're recording that cost over the life that you're using it, that's depreciation. Okay, so see how it's an asset. It stays on the books as an asset, but we're going to go ahead and expense it over the life that we use it. This accumulated depreciation, that's called a Contra asset account. What it does is it's married up against the equipment account. So under your balance sheet, you're going to have your equipment account, and it's always going to stay at the full, if it's $2,000, your equipment account would show $2,000. Then underneath it, you would show accumulated depreciation. After 1 year, it would be $400. Okay, and that accumulated depreciation is just what it sounds like. It's the accumulation of depreciation over time. So after 1 year, it would be $400. After 2 years, it would be $800. Okay, and the difference between those two is the net book value. I'm going to ask you to read about that. I'm not going to get too much into that in this chapter. All right, the second adjusting entry is unearned revenues. And you've already learned about unearned revenues when you collect cash in advance, right? So you've not recorded a revenue because you've not yet earned it. Revenue recognition principle: when you earn the money, you get to record the revenue. So we already have an idea of unearned revenue. It's when you collect the cash, now you owe the services. It's a liability. But the adjusting entry piece is that now when you get to year end, December 31st, you realize, you know what? I earned some of that money. So on October 1st, Ox University sold 1,000 season tickets to its 20 home basketball games for $100 each. Ox University made the following entry. Okay, so this would be collecting cash for $100,000, right? 1,000 times 100. and we would have recorded that as a liability, unearned ticket sales for $100,000. That's not the adjusting entry. That would be the normal entry on October 1st. But now on December 31st, Ox University realized that it played 10 of its regular home games, winning 2 and losing 8. Okay, so now we need to record the adjusting entry. Between October 1st and December 31st, we played 10 games. We played half those games. Remember, it was for 20 games. We played half of them. So now we get to record revenue for half of those games. Okay. So we know we need to record revenue, and revenue is always recorded on the right. Revenue, right. Revenue, credit. Okay. But what are we going to record as a debit? See this unearned ticket sale? This is our liability account. Once we satisfy that liability or part of that liability, we need to decrease that balance. So here we're going to debit or decrease that liability account by $50,000. We played half those games. So we still have a $50,000 balance in unearned ticket sales. But we need to show that we've earned 50%. Okay? And we're going to go ahead and record that revenue, ticket sales, of $50,000. Okay, that's the adjusting entry. Okay, our third adjusting entry is accrued expenses. Barton Inc. pays its employees every Friday. Year-end December 31st falls on a Wednesday. As of December 31st, the employees have earned a salary of $47,250 from Monday through Wednesday. So accrued expenses are expenses that have been incurred but not yet paid. If payday is on Friday, employees don't get cash till Friday. It doesn't matter that it's December 31st. You don't get a special payday. Okay, so what I like to do for all these payroll transactions is I set up a little calendar, Monday through Friday calendar, and I indicate where that where'd that year end occur? Well, here it occurred after Wednesday. So in 2009, the old year, we need to expense out 3 days of payroll. Okay. In 2010, the new year, we'll expense out 2 days of payroll, even though the employees will get the full 5 days on Friday. Okay. So payday, employees do not know the difference. Okay, this is an internal transaction. Nothing really happened here. We just need to record 3 days of actual payroll expense. Okay, so what's going to happen here? We debit wages expense. We incurred 3 days of wages expense, $47,250, and it's going to go to wages payable. We are not paying cash here. We are recording that we owe something. It's a liability. We owe wages payable of $47,250. Okay, when payday comes, we'll still pay out the full amount of payday. We'll record 2 more days of expense, and we'll reverse out, we'll decrease or debit the payable account. So here's my guy that says, well, where's my paycheck? I don't have any money, right? Remember, this is an adjusting entry. Actual payday is Friday. Nothing happened. Remember the tree that said at the spot, nothing happened? Nothing happened here. It's an internal transaction. All right, and the last adjusting entry that you're going to learn is accrued revenues. Accrued revenues are when you've actually earned the revenue, but you just haven't yet billed the client. So Smith & Jones CPA had $31,200 of work completed, but not yet billed to clients. Okay, perhaps these CPAs had, I don't know, a total contract of $60,000 that they would bill the client at the end when they've completed the work in its entirety. If that's their contract, they can't bill on December 31st just because it's the end of the year. Okay, that client's going to get pretty mad. They're going to call them up and say, but I signed a contract that said I didn't have to pay anything till it's done. But internally, these accountants have to record revenue earned. Okay, revenue recognition. You record the revenue once it's earned. Okay, so we're going to go ahead and record revenue. We know that revenue's on the right. Okay, so revenues are credit, but what's our debit? We're not getting cash. We're going to go ahead and record a receivable, right? Money received in the future. Okay, and our consulting fees revenue is credited. Okay, just remember, If we earn it, we have to record it. All right, so at this point, we've made it all the way to adjusting entries. Then we would prepare an adjusted trial balance. So we would go ahead and update all of our account balances and prepare true financial statements, okay, that reflect all the revenue earned, all the expenses incurred. Okay, they would adjust for any prepaids or unearned revenues. Okay, we would go ahead and prepare financial statements. Now before I take you to closing entries, I want to go ahead and go through, your workout sheet. Okay, so here we've got number 1 says prepare adjusting entries for these different transactions. Okay, so you could pause for a minute and complete these, or you can just follow along and maybe redo them later. Okay, so A says we have depreciation on the company's equipment for $16,000. Now remember that you don't need to compute depreciation in this chapter. We just need to know how to record it. So here we would have depreciation expense for $16,000. That's our debit. And accumulated depreciation, I'm going to abbreviate here, for $16,000. Okay, that's our journal entry. We would have a memo and a date. What is this date? December 31st. Okay, and if you're having trouble remembering that, just remember dead, right? Oops. Hello. Trying to give you guys some colors here. All right, do it this way. D-E-A-D for depreciation. All right. B, we have the supplies account has a $325 balance on December 31st, and $3,480 of supplies was purchased during 2009. The December 31st physical count showed $383 of supplies available. Okay, so remember that all those supplies went into a cabinet, and now it's the end of the period, and we need to go ahead and do a physical count, actually go to the supplies cabinet and count. So we started the year off with $325. We added in $3,480, and our ending balance was $383. Okay, so what we're looking for is how much did supplies decrease. So add up the left, 325 plus 3,480, subtract this balance 383, and you should get to 3,422. Okay, and I always work it backwards, so now go 325 plus 3,480 minus 3,422 should give you 383. All right, so now we need to go ahead and record the entry. So the entry is going to be a debit to supplies expense. Expenses are always debited for 3,422, and we're going to decrease our account by supplies 3,422. Okay, remember that a lot of students want to do something with that balance, but we're going to ignore the balance. The balance is essentially what's going to happen once we record, once we post once we post a journal entry, the balance in our account will be the 383. But what you need to do is find out how much got used, and you need to debit the supplies expense and credit the supplies account for that same balance. Equal debits and equal credits. All right, C says 1/5 of the work related to $15,000 of cash received in advance was performed. Okay, so the adjusting entry is not the cash received. The adjusting entry is back in the year we got cash in advance. Now we realize 1/5 of that actually got earned. Okay, so we need to record revenue, and I'm going to skip my debit here because I know my credit is to revenue. If I earn it, I get to record revenue, and 1/5 would be 3,000, right? 15,000 divided by 5. Okay, but what's my debit? Well, I know it's going to be for 3,000 because I need equal debits to equal credits. What's my debit? It's unearned revenues, right? I would have recorded that originally to an unearned fees or unearned revenues. So now I'm going to decrease that. Remember, accounting is just a database. I'm decreasing that liability account. Let me just say unearned revenues. Okay, so all I want to do is decrease how much is in that liability account. So my unearned started with 15,000. I just decreased it by 3,000. That means I still owe $12,000 in services. Okay, hopefully that's not confusing you. I'm just giving you a little extra analysis there. All right, D, the company paid a 12-month insurance policy on March 1st that cost $1,800. The entry was recorded to prepaid insurance. Now that is not the entry. A lot of students want to jump to that. Debit to prepaid insurance, $1,800. Credit to cash, $1,800. That is not the adjusting entry. The adjusting entry is what's happening on December 31st. December 31st, we're recording how much of that insurance expense was incurred. So it was a 12-month insurance policy that was paid on March 1st. Okay, so all of March counted. If it was paid on March 31st, March wouldn't count. But a 12-month insurance policy beginning March 1st. So use your fingers and say, okay, March counted, April, May, June, July, August, September, October, November, December. That's 10 months. 10 out of 12 months was incurred. So $1,800 times 10 out of 12 months means that I incurred how much expense? Okay. $1,500 is how much expense. Let me just double check my math here. Times 10 out of 12 months, it's $1,500. So now I record the insurance expense here. For $1,500. What's my credit? I'm recording expense. I've actually used 10 months. My credit is going to be to decrease my prepaid insurance. It's $1,500 got used up. Oops, not it. So I want to decrease my asset account so that the balance in prepaid insurance reflects only 2 months. Okay, and then finally E says an employee works 5 weekdays and is paid on the following Monday. I'm sorry, yes, paid on the following Monday. The employee earns $200 per day and December 31st falls on a Tuesday. Okay, so go here and do your Monday, Tuesday, Wednesday, Thursday, Friday. They get $200 per day. Okay. The employee, I'm sorry, when does it end? It is on Tuesday. December 31st is a Tuesday. So I need to expense $400, right? Okay, so here, December 31st, nothing's happening. Remember that the employee doesn't get paid or even know about this. But what we want to do is we want to record wages expense of $400 and wages payable of $400. Okay, let me give you Friday's journal entry. Okay, so 2 days got expensed, right? On Friday, actually it would be on Monday. Okay, on the following Monday on payday, the employees are going to get all 5 days worth of cash, right? I'm going to leave a debit blank, but cash is going to be $1,000. We're going to pay our employee for the entire amount, $1,000 cash. We need to expense out 3 days. So on Monday, we would record wages expense of $600. Okay, we can't record wages of expense of for these Monday and Tuesday because that already got recorded. If we record wages expense of 1,000, that means that we would double count Monday and Tuesday. So what happens is on Monday, we would go ahead and record wages payable. Remember, that's a credit. So if I debit it, I'm decreasing it. What I'm doing is I'm clearing out the balance in wages payable by debiting it. Okay, I know that the problem didn't ask you for that, but I believe your homework will ask you for the second step, what happens on payday. So that is what happens on payday. All right, again, this is a tough chapter for students. So if you need to go back and review adjusting entries, rewatch it, reread it, do whatever you need to do to make sure that you understand these entries. Now we're going to focus on the closing entries. Okay, so we're going to start off the year. Okay, we start off 2010 or whatever year we're starting on, a brand new clean slate. How do we do that? We want to close all of what's called temporary accounts. Revenues, expenses, and dividends. Red is all temporary. Okay, we're not going to do anything to the permanent accounts, assets, liabilities, common stock, and equity. Let me explain, why. The purpose of most businesses is to earn money. Okay, and if it's not to earn money, if you're a nonprofit, it's to support the services using money, right? It's all about money. So in order to accurately reflect your net income each year, you need to record revenues and expenses. But at the end of the year, you need to wipe those out so you can start again. You need to record new net income for 2010, and new net income for 2011, and new net income for 2012. So every year you have to wipe out revenues, expenses, and dividends. And if you think about it, think about your W-2. It does not record all the wages earned since the day you were born. It records only your wages for 2012. Okay, your income taxes are for 2012, not for the entire life. So we operate on a yearly basis. Permanent accounts, like an asset, cash. You go to bed on December 31st and you have cash in your pocket, you should wake up on January 1st with the same amount of cash, or with the same car, or with the same amounts that you owe. Okay, they don't go away at the end of the period. All right, so the permanent accounts are accounts that stay the same. They don't need to be closed out at the end of the year. Assets, liability, common stock, and your retained earnings stay the same. Okay, so there's 4 steps to closing entries. First, you close revenues to a temporary account called income summary. Income summary does exactly what it says. It's a summary of your income for the year. Then you close your expenses to income summary. Then you close your income summary to retained earnings. So see how income summary is very, very temporary. It's open for 3 transactions and 3 transactions only. You close your income summary to retained earnings. Okay, so essentially income summary ends up being your net income and you're dumping it into retained earnings, just like the statement of retained earnings. And then finally you close dividends to retained earnings. So let's see how that works. First, you close your revenues to income summary. Think about revenues. They are increased on what side? Remember that revenues are always recorded on the right or always credited. But if we're starting over, if we're closing everything out, you're going to decrease revenues by the total amount. So you're going to debit revenues. This is the only time you will ever debit revenues is when you're starting over. You're closing out the accounts. So you always record revenues to the right except when you're closing them. You close them to income summary, so that's a credit to income summary. Great flashcard opportunity right here. How do you close out revenue? Debit revenue, credit income summary. You close expenses to income summary. Expenses are always debited, remember? But not if you're closing them out. If you look at your T account, expenses are debited to increase them, credited to decrease them. And if we're making them 0, we want to debit income summary and credit each expense account. Okay, so you would credit each one. Remember, these are databases, so you want to close out each individual expense account. And you're going to debit the income summary for the total. Okay, it's just a database. We're going through, closing them all out. Then you take the total of income summary. So you would balance the income summary account. You'd add up the debits, add up the credits, get the balance, and you'd close out the income summary to retained earnings. So if you made net income, that means you would have a balance in income summary that would be a debit balance. Credit balance. You'd close out income summary with a debit, and you'd credit or increase retained earnings with a credit. Okay? So you close out your income summary, increase your retained earnings. Fourth step, and remember that income summary is very temporary. It's only open for 3 transactions. The fourth step is to close dividends to retained earnings. Dividends are always debited. Remember, they're part of ed, except when we're closing them out. So when we're closing them out, we're doing the opposite of everything. So here we're going to debit retained earnings and decrease retained earnings and credit dividends. Okay, wiping them out. So going back to your chapter handout, okay, we're going to go to, let me get rid of this piece. Prepare closing entries. Okay, and here is our adjusted trial balance, so we need to figure out what do we want to close out. Step 1, close out our revenues, and I only see one revenue account. It's service revenue. Okay, remember that revenues are always recorded on the right, so to close them out, we need to debit service revenue for 2000. Okay, so service revenue is going to be debited for 2000. And I'm going to close that out to income summary for 2000. That's step 1. Step 2, I want to close out expenses. Okay, there's 2 expenses here. Depreciation expense and supplies expense. See that the balances are debits here. Expenses are always debited, except when we want to make them 0. Now we're going to close out the expenses. So we're going to debit income summary, and we don't know what we're going to debit it for. We're going to credit each of the expense accounts. So depreciation expense is 300 and supplies expense is 200. Okay. Oops. So income summary is going to be debited for the total. So 300 and 200 is 500. That means we have equal debits to equal credits. Okay. That's our second journal entry. Step 3 is to close out income summary. Okay, so I'm going to go over here and just look at my income summary. I have a $2,000 credit balance to income summary and a $500 entry. It's a debit. That means my balance is $1,500 on the credit side. But if I want to make this account equal 0, I need both sides to equal the same, right? Because to balance an account, I take the left and the right, and the difference is the balance. So to make this account equal 0, I need a $1,500 debit to income summary. Okay, where does that go? It goes to retained earnings. It increases retained earnings. Now, most students want to know, what about the $1,700 retained earnings balance? That is the beginning balance. Okay, if you were to prepare the statement of retained earnings, it would start with $1,700 plus net income minus dividends equals our ending retained earnings. We've just done that. So now the new retained earnings balance after we post will be, what is that, 3,200? The new balance would become 3,200. Okay, and step 4 is to go ahead and close out dividends. So there's $200 in dividends. Dividends are always debited except when we're closing them out. Then we're going to go ahead and credit dividends. Okay, and then let's go ahead and debit retained earnings. Okay. So that now when we post each of these entries, essentially we're going to wipe out dividends, we're going to wipe out revenue, wipe out our expenses, and our post-closing trial balance would end with retained earnings. Okay, a balance of $3,200 in retained earnings. This would be our post-closing trial balance. All the rest of this would be eliminated. Okay, whoops. Okay, oh my goodness, I don't know why it keeps doing that. It doesn't like whatever I'm pressing. So that would be your post-closing trial balance. And that is it for Chapter 3. That's pretty much the entire cycle, accounting cycle. We analyzed, journalized, posted in Chapter 1, or I'm sorry, Chapter 2. We prepared an unadjusted trial balance, and we looked at any additional entries that we needed to make when nothing really happened. It's just internal transactions. Then we prepared an adjusted trial balance. We made final financial statements, and then we closed out our temporary accounts, revenues, expenses, and dividends, and we prepared a post-closing trial balance. All right, again, if you're struggling with this material at all, make sure that you review, get help, make it through the coursework, and then you study. Chapter 3 is the end of unit number 1, so the next thing that you'll have in exam number 1. In the meantime, you want to make sure that you have all these accounts down, know where they fit in the accounting equation, know which side is an increase, which side is a decrease, and be very familiar with all these transactions and the adjusting transactions and the closing transactions, because when you're taking the exam, it's all together, and you've got exam anxiety too. So the more comfortable you are with each of these pieces, which is why I encourage flashcards, because it gives you the ability to be more comfortable. The more comfortable you are with each of these pieces, the easier you're going to feel about the exam. So practice, practice, practice. Remember, you have so many hours each week that should be devoted to this class. Make sure that you are taking advantage of each of those hours. And even if you're finished with homework, be quizzing yourself. Have a great day.